Hey, in this video, I'm gonna look into some riders of life insurance. So riders usually is beneficial to the policy owners. Well, insurance companies think it's beneficial to you. So if you want them, it's addition benefits to you, so you have to pay them. So provision is usually exists in the standard life insurance, which is required by the state insurance law. Then it's different from rider. Rider is considered in additional benefits insurance company want to sell to you. So let's look at some riders. First is a term rider. Some companies allow a whole life policy owner to add a term rider for a specific period of time because the underwriting, acquisition, and the marketing costs are already covered. The term rider may cost less than the separate term policy. Generally, term are available for the number of years, 10 or 20, designed to cover a mortgage or other needs are anticipated and at a certain time period. This is very interesting. Instead, by a term life insurance, you add a term rider. Let's see this example. Say Henry needs $1 million in death benefit cover and prefer whole life to term insurance, but cannot afford the premium $1 million whole life policy. So his planner recommended is purchase a $250,000 whole life policy and add a $7,500,000 term rider. So Henry has a $1 million death benefit protect needed at a premium he can afford. So this is very interesting. You can buy a $250,000 whole life insurance at a $750 term rider. So that's a very neat rider, right? Another thing is called cost living rider. So basically increasing the death benefit, a cost living rider can add to the policy that will increase the death benefit by inflation each year. The insurer requires no evidence of insurability. That can be good. Accidental death benefit. This is very interesting. Okay, this one the best is with an example. Say Derek has a $500,000 life insurance policy with $1 million accidental death benefit rider. If Derek dies due to a heart attack, a natural cause, the insurance company will pay his beneficiary $500,000 if he dies as a result of car accident. His beneficiary will receive $500,000 life insurance benefit plus $1 million accidental death benefit for a total payout $1.5 million. That's very, very interesting. Why is accidental death benefit isn't well, it's very interesting. Anyway, that's the accidental death benefit rider. Guarantee insurability option. So basically say the guarantee insurability option, also called a guarantee purchase option, permits the policy holder owners to purchase more life insurance on a younger insured at a specific time and in a specific amount without providing evidence of the insurability up to a specific age limit, which is often insured age 40s. It is a typical offer to purchase a cash value policy. It provides that policy purchase under the rider will be issued with the same classification and with the original policy. Okay, this in guarantee insurability option. So basically, if you want to buy a new policy, you have to go underwriting, health check, make sure you are not sick, right? So this one just said, well, you don't have to do that. Guarantee insurability. So basically for some, some people, they life changes, you get married, you get a kids, you get a wife. So you your death benefit need increase, right? So then in that situation, you can get this rider. In the future, you can buy more insurance without go underwriting again. So that's a guarantee insurability option. Spouse or children riders. So this one is very interesting. So certain insurance company will allow spouse or child to be added to cash value policy as insured for the specified amount. The amount typically small, such like $10,000 and $25,000 coverage. So the spouse or children rider is generally a level term rider and may permit a conversion to the cash value coverage without evidence of insurability prior to termination at the death of the insured. So basically, it's a term insurance, but you can convert to a whole life cash value insurance in the future. This rider with a fewer or no underwriting requirement is an excellent tool when insurability issue exists. Then, as a children rider has a number of significant benefits. The first is the insurance on children can prevent the financial problem in an event of a child dies. First of all, I don't understand why get a life insurance on the child. So anyway, so that's what they said. The second is the provisions that a child normally can convert the rider into a cash value when they become an adult. So this particular benefit may be for amount 3 to 5 times larger than the amount of the rider. The conversion can include in the guarantee insurability rider as well. So the third benefit is the insurability of the uninsurable child if the rider is in place prior to the birth of the child. Generally, this must be a second child as soon as the infant is 15 days